expandCFO.
I want to share a question I got lately that I think is helpful to many. Here's the question. A lot of wholesale executives point to rising supplier costs or inflation as the main reason their margins are shrinking, or at least they think that. Where do you actually see margin compression coming from inside the operation itself? It's true that many blame margin shrinkage on rising supplier costs or inflation, but really what we usually see is most of the shrinkage comes from operational blind spots or inefficiencies that you don't even know about. One of the biggest is inventory holding costs, having too much cash tied up in inventory. That's a fairly well-known issue that wholesalers and executives deal with for cash. But I think a certain metric maybe that can be used that's maybe not as well known, it's called GMROI, G-M-R-O-I, GMROI, and it helps measure and the trade-off, the return on investment of inventory, and making sure that your higher margin products, you have those stocked well, but you don't overstock low margin products. That's where you can really eat up a lot of cash, is if you're holding on to a lot of low margin inventory products, they suck up cash, but they don't give you a lot of profit when you do sell them. Another area where margin really becomes eroded and it's not always thought of is with the landed costs of raw materials that you buy. Big one right now are the tariffs that everyone's talking about, and that seem to change every single day. If you're not planning for them, it can take a big bite out of your margin. I know some clients who actually have contracts with their customers to sell a product at $10 a unit, and with the new tariffs, it's costing them $20 to buy that. And so they're literally losing money every time they sell it, and because they're in this contract they made before recent tariffs. So that's crazy to deal with right now. Sort of unprecedented times. Right now, with tariffs being all over the place, during COVID, freight costs would go up, they'd go down. It's really hard to plan for those, and those were one way where your margins just eroded without even sometimes being aware of it. So that's where tracking the true landed costs of your materials that you buy is hugely important. And so you have a full understanding, not just of the product cost. That's usually the easiest thing that you're aware of, and you have a contract with your supplier. But then those hidden costs, those tariffs and the freight that are not always known well up front, that's where we typically see margin erosion. Another area where there's erosion of margin that is not always, it doesn't hit you in the face, you're not always aware of it, is when, as a business, you're not allocating the real true costs of fulfilling your orders to each channel. So most businesses these days, they sell different channels. You've got the DTC channel, we're selling direct. You've got a wholesale channel where you're selling maybe a lower product margin, but in higher quantities. And I think there's an infatuation that can be had with the DTC channel because you have a higher product margin. You sell the product typically at your top retail price, but your cost is pretty low, so your product margin is really nice. But if you're not factoring in the extra costs of the direct labor to pick and pack these direct, when you're selling direct, you're selling ones and twosies of products versus when you sell wholesale, you're selling pallets, whole loads of pallets at a time. That's easier, more efficient to pack and to ship in pallets than it is to pick in one little thing in a box. If you're not allocating your direct labor by channel, you may think your direct channel is way more profitable than it truly is. It actually may make your wholesale channel look like it's not as profitable if you're not allocating it properly. You can also have much higher customer support costs. Now, this isn't impacting your gross margins. This is usually treated as an overhead cost, your customer support. But that can go way up when you're selling direct and you're dealing with many more smaller customers directly, and they're contacting you saying, I don't like this, I don't like that, this is the wrong color, this is the wrong size. You have more customer support costs, and that's one of those hidden things that can kill your margins. and that you may not be thinking about, especially if you're just looking at your gross margin and not the whole channel cost together. So really at the end, you don't need better vendors to give you better pricing. It's really, you just need to have better visibility into your financials and your true cost structure of those channels. And that's how you can help make sure your margin isn't leaking away on you. So how do you go and improve your financial visibility so you better understand your margins? Because you may be showing a nice, healthy 50% or greater gross margin, but at the end of the day, your real profitability is much lower. So here are some accounting methodologies, some accounting mistakes I've seen, quite frankly, at some clients that end up masking the true margin. One thing we've seen is improper accounting of direct labor, which can mask operational inefficiency. So we've seen clients where their direct labor costs are just lumped together with their corporate salaries, and it's all shown in overhead instead of splitting out the direct labor separately into COGS, into cost of goods sold. And if you don't split it out into COGS, then your gross margin looks much better than it is in reality. This can cause you to overlook manual processes that are happening in the warehouse if you're not separating out your direct labor costs. One example, not having a warehouse management system, a WMS with barcode scanners. Everything's being done manually. Things are being picked, hand typed into the system, very manual. That can take a long time. Another example, if you're not integrating your shipping and your fulfillment, your printing of your shipping labels, and your tracking information with your ERP like NetSuite or your website platform like Shopify, that means you go over here to one system, you print a shipping label, then you got to go into your ERP, hand type the tracking number, and then you got to go over to Shopify and also retype the information and click and let your customer know you just shipped it out. There's connectors, there's integrations that can do all that automatically. So you click one button to print a label and it pushes it all through. If you're not tracking direct labor separately, you may not even realize how much time is being spent on these manual processes. One possible follow-up question is, where do things like freight, holding costs, or customer discounting tend to sneak past finance's radar? Rarely do I see our wholesale clients, whether it's the CEOs or the COOs, rarely do I see them able to look at their true margin by product or by channel, by customer, or even like customer segment. And that's because these extra costs are not being allocated to the product specifically or the channel or the customer. They're just being booked generally on the financial statements in the overhead section, and they're just there as a cost. But things like 3PL costs, surcharges, maybe expediting, shipping, repacking fees, customer refunds, these all hit margins silently, and you don't even see them if you're not tracking them properly against the specific products and customers that they're related to. Now, how should a COO start tightening up their margin without completely overhauling the business? It's a good question, because you could just delay action and say, we need a whole new ERP system and we have to go through this 6-figure ERP implementation before we can even start to think about tightening up our margins. The reality is that's just an excuse. You could be on the worst system right now, and you can start looking into things right away. Sure, it may not be the most efficient process, but it can get you started. And all you need is a copy of your bills and a spreadsheet, honestly. And take one purchase order that you placed with a vendor, track the costs of those items, spend the time to go get your freight bills related to that purchase order, and look at your duties and taxes that you paid for that order. Total it all up just for that one purchase order, and you get that total cost. That's your landed cost that we talked about. It's with your freight, your taxes all in, plus the product cost. Divide that out by the number of items you purchased in that purchase order, And now you have your landed cost for one unit. Go look at a sale that you made to a customer. Maybe pick one sale that you made on the DTC channel and then another sale you made wholesale, and look at what you charge them for that same product. Compare it to what your landed cost of that product was. And that's a simple way to look at what your true product margin is without having some fancy ERP or overhauling your business right now. That is a good way to look at it. Now, if you want to take that a step further, think about, just guess even, or estimate, how much time did it take our workers just to bring in this one order, to stock it in the shelves, and then to pick it, to fulfill that DTC order or that wholesale order. Think about how much time they spent. How much do you pay them? Total that up. Now that's your direct labor for that. Subtract that out from your product margin, and now you get pretty close to a true contribution margin on this inventory item, and you can do that today. You don't need to wait for a new system. You can start digging in today. If you're not sure where the leaks are, that's not your fault, but it is your problem. The fix? Start measuring what matters. And if you're a little unsure where to start on what to measure or how to do it, feel free to click on the link in the description and book a free consultation with us. We're happy to look under the hood with you, take a look at your numbers, give you some ideas on what you could start measuring that really matters. Your revenue chart is up and to the right, but your bank account is begging for a break. Why? Revenue doesn't equal cash, especially when growth costs more than it returns upfront. A lot of e-commerce founders, they celebrate a sales spike like it's a huge win, and they should. But from my experience, this revenue boom can actually hurt cash flow, especially if it's not managed well. With this revenue bump, your P&L looks good, income's up, profits are up. Quickly, you can see your actual cash on hand in the bank can tell a different story. It's a good problem to have, but now you need to get serious about managing your cash. If you're not managing your cash flow well, then every spike in sales can mean you have more cash going out the door before it comes back in. Where do we usually see cash getting tied up when brands start scaling fast? The biggest use of cash is buying the inventory you need to sell. And the longer the lead time between when you have to pay for the inventory you buy, the raw materials, and when you sell it to your customers, the worse of a cash flow crunch you're going to see, especially the faster you grow as an e-commerce business. So if you don't have a lot of negotiating power with your suppliers, they'll make you pay a down payment up front, sometimes 100%. Sometimes it can take a couple months from that down payment to when they make your product and ship it to you. Sometimes shipping can take a while. You finally get the product in your warehouse, and then you turn around and sell it, and that's when you get paid. That can be a long time. The faster you're growing as a business, the more that hurts your bank account. The second area where we see cash being tied up when a brand is scaling fast is with your CAC, your customer acquisition costs. This is the money that you're spending to go acquire new customers. And the more aggressive you are, the faster you're scaling, the more money you're spending up front to go acquire those customers. Let's say it costs you $500 to acquire a customer. That's through running various ads and other marketing and content. If they buy $100 of product from you every month at, let's say, 50% gross margin, it's going to take you 10 months to recoup that CAC, that customer acquisition costs. So you throw out $500 today, you got to wait 10 months to get it back to where you break even on that customer. After that, you're making ongoing profit for the lifetime of that customer. But for 10 months, you're just trying to get back to even. Now, if you're just doing one customer, it's $500, not a big deal. But if you're doing 10 new customers a month, that's $5,000 that you're outlaying this month that you won't see for 10 months. If you're scaling faster and you're adding 100 customers in a month, that's $50,000 you're going to burn in that month to add those customers. You can do the math however you want, but the more aggressive you are with acquiring new customers, the more cash you need to fund it. So we've talked before about inventory as a silent cash trap. Now let's break down how a lack of ERP visibility turns inventory into a working capital black hole. Without a good ERP implementation, owners can underestimate how much working capital is trapped in their inventory. And by working capital, let's call it what it is, it's cash. Without clear visibility into sell-through ring, dead stock, slow-moving stock, you're basically flying blind on what you need to order. Follow-up question we're often asked is, what other kinds of metrics should a founder or COO be watching to avoid overbuying or getting stuck with dead stock? I'd say there's a few that come to mind that I think are the most important. And the first one I'm going to give you is a vanity metric that everyone thinks they need to track, and that is your overall days in inventory, or sort of a related metric called inventory turnover. When you look at that number and you look at it across all of your inventory, it's not really that helpful. It's just telling you on average, you turn over all of your inventory in a certain period of time, whether it's 3 months or 6 months, but that's usually not helpful. That's why I call it a vanity metric. What's more useful is break your inventory down into key product segments and then look at your inventory turnover for each product segment separately. That's where you get to start to see some trends, because certain items will move quicker, have a higher inventory turnover. Other ones are going to move more slowly, have a lower turnover. And looking at that and pairing that with the gross margin, how profitable those items can help you determine a strategy to decide what's more important to focus on in buying and making sure you have stocked well. A related metric to that is the Jim Roy metric, and that specifically tells you your return on investment of your inventory, and ultimately you optimize it by keeping less inventory on hand for low margin kind of commodity goods and optimize it to keep a proper sufficient inventory balance for the high margin products. So why is that important? If you're stocked out on a low margin product and you miss a sale with a customer, that doesn't hurt you that much. There's not much profit there. You don't really lose out. But if you are out of stock on your high margin products and you can't make a sale, that's a lot of profit you give up by not having that on hand. So if you only have so much cash to spend on buying inventory, you want to focus on the high margin products. Besides tracking metrics, forecasting cash flow is critical. We've all seen the spreadsheet cash flow forecast that looks great, looks pretty. There's nice colors, there's fancy formulas, but then reality hits and it falls apart and it becomes not useful. So a question we often get is, what's the biggest risk in relying on a manual forecasting tool like this spreadsheet that doesn't have real-time data feeds? The main thing is you want to avoid something that just looks pretty with the fancy formulas, but is always lagging. These are complicated to maintain and they don't have live feeds of data, so they're not updated. So it's like you work hard, you build this big project, you build this forecast, everyone likes it, but then tomorrow it becomes useless because it's not kept up to date. So I like to have a simple forecast. I like to keep things simple whenever possible. And simplicity means you need to focus on what really matters. And having a simple forecast, but a direct live link to your ERP or accounting system, that's really the key. Whether you're on NetSuite or even something like QuickBooks Online, there are tools out there that can help make this connection for you, give you that live feed between your cash flow forecast and your ERP system. That way, what you've built isn't just useful today, but can be useful tomorrow and into the future. If you want to start managing your business with a live dashboard, click the link in the description to unlock your access to the e-commerce cash flow fix kit.
expandCFO